Thank you, Neerav. Good day, everyone, and thank you for joining us on Alicon Castor Oil Limited's Q1 FY24 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, Mr. Veera Babu, Group COO, Mr. Shyam Agarwal, Chief Marketing Officer at Alicon Castor Oil, Mr. Andreas Heim, Managing Director of Alicon Castor Oil, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castor Oil Limited. Mr. Vimal Gupta will cover the financial performance for the quarter, following which Mr. Agarwal will walk us through the operating highlights. Thereafter, Mr. Andreas Heim and Mr. Rajiv Gupta will provide insights on developments in the global and domestic markets, respectively. Mr. Veera Babu will then share a brief summary on key focus areas, after which we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier and have been uploaded on the respective stock exchanges. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good afternoon to all our investors. Thank you for taking the time out to join our earnings call. I trust that all of you have had a chance to review our earnings documents, which were shared yesterday. As we have indicated earlier in 2018-19, there was the best year in the last few years for the global auto industry. Our assessment is that in quarter one of FY24, the domestic industry has reached a performance level of approximately 81% of the base set in quarter one of 2018-19. For the international auto industry, the rate achieved in April to June of 2023 is about 84% level of the production in April to June of 2019. At Alicon, our revenue performance in the first quarter is around 120% of the benchmark that we had set in the corresponding period in FY 2018-19. This clearly shows our performance when we compare to global and domestic auto industry. This has been driven by the addition of new parts as well as new customers. The envisioned business transformation involves a strategic focus on multiple avenues for growth, which we have categorized into 5 pillars. These pillars are continue to scale strategic production in the IC business, addressing the opportunities from carbon neutral technology, including battery electric vehicles, hybrid electric vehicles, fuel cell and hydrogen cell technologies. Opportunities from structural parts or technology agnostic parts, which remain consistent no matter which fuel technology is used to power the vehicle. Non-auto business encompassing opportunities from sectors such as defense, energy, telecom, to name a few, where our competencies can be leveraged. Enhance customer wallet share through value-add and combining products to offer our customers a one-stop solution. There are some key themes for investors to monitor and to evaluate our progress and to understand the areas in which Alicon has transformed the business model. The first aspect that we had communicated and which is visible in the business is the enriched product mix. The share of PV and CV in our revenue mix has been steadily increasing as we have focused on scaling up business from these segments, as well as carbon neutral technologies and technology agnostic parts. Their share of business from these segments will grow at a faster pace than from two-wheelers, leading to better product mix. Secondly, the customer profile is changing and there has been addition of some marquee global names to our customer list. There has been a considerable increase in the number of leading global OEMs and Tier 1 suppliers that we cater to. Thirdly, the component of business that is emerging from expertise in design, research and development and value engineering is increasing. Earlier, the key levers for business wins were reliability and cost competitiveness. Today, Alicon is winning business due to capabilities and design engineering, which is contributing to the changing nature of the business. Customers now look at us as a solution provider rather than a source of lower cost components. In that backdrop, I will now run through the financial performance for the quarter under review. In quarter 1 of financial year 24, total income stood at rupees 355 crore as compared to rupees 344 crore in quarter 1 of FY23, higher by 3% on a year-on-year basis. More importantly, on a sequential quarter basis, we have delivered a revenue growth of 11%. This has been driven by production commencement of new parts and new customers. Further, some of our customers witnessed stronger than expected demand, resulting into increase in volumes. There was also some benefit of two-wheelers volumes as OBD regulations which kicked in from April contributed to volumes which spilled over from quarter 4. As a result, we have witnessed a slight increase in utilization level for plant in India and Europe, which operated at a utilization level of around 65%. The gross margin for the quarter, which was 50.42% in quarter 1 of financial year 24 compared to 47.48% in quarter 1 of FY23, is higher by 294 basis points on year-on-year basis, largely due to a more favorable product mix. There has also been a slight contribution from the stabilizing of alloy prices at lower levels. On a quarter-on-quarter basis, the gross margin has reduced from 51.6% to in quarter 4 of FY23 to 50.42 in quarter 1 of FY24. This quarter, we consumed higher cost inventories, which have now fully passed through the system. There has been a sharp rise in employee costs, which are higher by 20% year-on-year and 18% over the immediate preceding quarter. This is due to increase in minimum wage as well as the effect of the increments which have kicked in from April onwards. Lastly, there was the impact of the ESOP cost of around 3.3 crore, which is a non-cash charge. Other expenses were lower on a quarter-on-quarter basis as we have focused on cost-cutting initiatives as well as at all levels of the organization. Moving on the profitability front, EBITDA for the quarter stood at rupees 40 crore against rupees 38 crore in the corresponding quarter of the last year. Margins for Q1 of 24 stood at 11.3% as compared to 11% in the quarter 1 of FY23. I am pleased to share that despite the increasing costs, we have reported an improvement in the EBITDA margin by 30 basis points on a year-on-year basis and nearly 100 basis points on a quarter-on-quarter basis. Importantly, if we adjust the non-cash charge for the ESOP cost, the adjusted EBITDA margin is 12.2% this quarter. This is an increase of over 100 basis points on a year-on-year basis and close to 200 basis points on a sequential quarter basis. Some of you would recall our earning calls in the prior quarter, where we had indicated that we will increase the EBITDA margin by 100 basis points in FY24. We have done more than that in the first quarter itself and are poised to build up on this through the year. We remain confident about the general upward direction in margin given the improving product mix. Further, we are on the cusp of launching our captive solar plants in India and Europe, which will contribute to assured power while helping to ease the power and fuel costs. In the prior quarter, we had indicated that we had incurred upfront costs due to the initial stabilization requirements of new products. These have now been stabilized and contributed to enhanced unit contribution. Finance costs were higher by 33% on year-on-year basis from 7.1 crore to 9.5 crore in line with the increasing in interest rates. We also witnessed an increase in the depreciation, which was higher by 23% on year-on-year basis from rupees 15 crore in quarter 1 of the last year to 18.4 crore in the quarter 1 of the financial year 24. The increase in depreciation has been driven by two factors. One, we have taken some machines on lease, and as per accounting standards, we have to factor the maximum useful life of 5 years, which results in a higher depreciation cost. Secondly, we re-evaluated and shortened the useful life of some other assets, which has also contributed to the increase in depreciation. As a result of Higher finance cost and depreciation. Profit after tax for the quarter 1 of FY24 stood at 9.5 crore as compared to 10.8 crore in quarter 1 of FY23, lower by 12% on a year-on-year basis. On a sequential quarter, while PAT was lower by 2% from 9.7 crore to 9.5%, it must be noted that PAT in quarter 4 FY23 included a reversal of a deferred tax of around 6.85 crore, thereby elevating the base. I am pleased to share that our board of directors has approved a final dividend of rupees 3.75 per share of a face value of rupees 5 each, which equates to 75% rate of dividend in addition to the interim dividend declared earlier. The total dividend for the financial 22-23 comes to rupees 6.25 per share of a face value of rupees 5 each, which equates to 125% rate of dividend. This is substantially higher than the dividend paid in the prior years, which reiterates our focus on shareholders' value creation. On the capex front, we have deployed rupees 15.6 crore during the quarter and continue to have a target capex deployment of around 90 crores in FY24. Coming to outlook, with a strong start of the financial year and a healthy pipeline of SOP from new products and new customers, we are poised to take the business to new heights. We aim to deliver a revenue of over rupees 2,200 crores by 25-26 against the earlier estimates of 2,000 crores. This equates to a CAGR of over 16% over a period of 3 years. Our confidence stems from the new orders which we have received and the discussions with the customers on new technologies and solutions. This will be accompanied by an improved margin profile, and we aspire to take EBITDA margin to around 14%, and we have already attained an adjusted EBITDA of 12.2% in quarter 1 of FY24, which we will look to build on further. Lastly, we are looking to drive efficiencies across the balance sheet and working capital, which will contribute towards enhanced return ratios too. On that note, I would now like to hand over to Mr. Shyam Agarwal, who will talk about operating highlights for the business.
Thank you, Mr. Vimal. Greetings to all of you. As Vimalji has indicated, we have started the financial year 2023-24 on a positive note. We have performed well in new markets and new products. The industry backdrop remains mixed, with some segments reporting good momentum and others witnessing challenges due to supply chain issues. Despite this, we have delivered good revenue growth, especially on a sequential quarter basis. During the quarter, we have added 17 new parts from 11 customers, including 2 new logos. This includes 3 parts from the EV, 6 parts from the ICE, and 3 parts from the non-auto, and 5 parts from the structural segment. Out of the 17 parts, 10 parts are for international business and 7 parts are for domestic business. During the quarter, we have added a new part under the e-highway segment with a prominent European customer. We also added a new part in a new market for autonomous driving with Volkswagen Commercial. These businesses will showcase capacity and capability to both existing and potential customers. Alicon has also won its maiden order amounting to 90 crores per annum, requiring application of the friction stir welding technology from a European customer for a EV application. The FSW technology can be a key enabler for us to increase the EV business 2-fold by 2025-26. In the ICE segment, we have added a new subcategory of products with our existing customer Daimler. We have increased the wallet share from Maruti Suzuki with the addition of new cylinder head. In the non-auto business, we have added business in the existing portfolio and are in active discussion with existing customers for further addition of parts. During Q1 FY24, Alicon has booked new orders aggregating yearly average sale of 110 crores. With this, our total order booking has reached to 8,500 crore, which is executable over a period of 6 years from 2023-24 up to 2028-29. The other aspect to highlight is the improving product mix. From the new business won, about 52% are from the carbon neutral business, which is a value assertive. Further, 90% of new business during the quarter is for four-wheelers, which we will serve to enrich the product mix further. The commencement of supply for these orders, along with the start of production across our aggregated orders booking, will contribute to the revenue momentum. We remain cautiously optimistic about our prospects, even as forecasts for the global auto industry indicate possibility of a sluggish second half. Another focus area for our value creation approach is to increase the value addition mix from our products for four-wheeler and the CV segment. In carbon neutral technology, we are in discussion with existing customers to increase the scope and our portfolio. Our focus remains on passenger vehicles, commercial vehicles, and export opportunities, as we see a greater scope of value addition in these areas. The focus is to continue to build the position of Alicon as a consistent and reliable supplier with a solution-driven approach. Customers should understand that Alicon will offer unique solutions by leveraging newer technologies. We had talked about 3D sand casting in the prior quarter and have made good progress in friction stir welding too, with our maiden order win. These applications will enable us to offer parts for the future which are light, strong, and of high quality. On that note, I would like to hand it over to Mr. Andreas Heim to throw light on the global issue.
Thank you, Shyam. A warm welcome to all of you. I will briefly cover the developments on our international business. The international business has done well, and we have surpassed our targeted production for the quarter. European operations are gradually emerging from the challenging situation witnessed last year. Gas prices have stabilized and energy availability has improved, which combined with some cooling in the oil prices is providing our customers confidence to start ramping up their activity levels. In our existing business this quarter, we witnessed an increase in EV products for Samsung, which is a tier 1 supplier. As explained by Shyam, we have added 5 new parts from 2 new logos in this quarter in the global business. We have added a part from Volkswagen commercial vehicle for autonomous driving applications.
Sorry to interrupt.
While we have
so there is some kind of a thumping sound from your line. Let me disconnect and reconnect. Participants, please stay connected while we rejoin the management's line back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected, so you may go ahead.
Thank you for reconnecting me. As explained by Shyam, we have added 5 new parts from 2 new logos this quarter in the global business. We have added a part from Volkswagen commercial vehicle for autonomous driving applications. While we have done work for the passenger vehicle business for Volkswagen, this is the first time we are working for the commercial arm. We have added 4 parts with some prominent European OEM, leading the additional of another Marquis logo for us. We have also been invited to work on development for a prototype for parts breaking project. This images development of e-highway for electrification of highways. This will be achieving by providing overhead lines as it done in the case of railway lines. Since the key challenge for electronic commercial vehicles in the size and life of the battery, the e-highway concept that is being prototyped, which will be enable commercial vehicles to recharge on the move, which will solve for the challenges of battery size and integrated charging infrastructure. We are also in discussion with a marquee global customer for a new part on the category of structural or technology agnostic parts. The order which we have received from JLR last year is processing well with involvement of the best technology and resources both locally and overseas. As we had indicated last quarter, the end of the winter has added demand for two-wheelers, and we have seen that reflected in increased volumes for BMW and KTM, which picked up as in the desert. The global business contributed to 23% of the global revenue during the quarter, and it's slightly higher than the contribution from quarter 4 23, as well as the previous financial year. On our initiative to reduce costs, we can share that we have commenced installation of solar panels and expect this to be activated in quarter 3, which will lead to reduction in energy cost and reduce the carbon footprint. The outlook remains mixed. The stabilizing of energy costs and commodity prices can improve prospects. However, the forecasts for the auto industry indicate softening of demand over the course of the year. Hence, against our original expectation of 5% growth for the global auto industry in calendar year 23, we now anticipate a growth rate between 4 to 5%. On this note, I would like now to hand over to Mr. Rajiv Gupta, who will cover the developments in the domestic business for the quarter.
Thank you, Andreas. Good day, everyone. In quarter 1, FY24, domestic automobile market witnessed 3% growth on a year-on-year basis, driven by 7% growth in the passenger vehicle, 1% growth in the two-wheeler segment, and 2% decline in the commercial segment on the year-on-year basis. The domestic passenger vehicle industry volumes grew by 7% year-on-year in quarter 1 amid ramp-up in the production and continuing interest in the SUVs. The domestic two-wheeler industry was expected to benefit from a spillover in the demand from quarter 4 FY23 due to the impact of OBD regulations. However, there was only marginal increase in the volumes due to supply chain issues with few vendors. Further, two-wheeler exports also remained weak on year-on-year basis. The domestic commercial industry volumes declined by 2% year-on-year. The sequential decline was sharper than usual due to seasonality and some preponement of demand in quarter 4 FY23 because of the RDE and the OBD2 norms coming into effect from April 23. As explained by Mr. Sham earlier, on new business we have added 7 parts from 6 customers in the domestic business. These are largely existing customers for whom we have experienced expansion of portfolio. We have increased the portfolio with Maruti Suzuki with addition of a 4-wheeler cylinder head. Further, we have added a new subcategory cylinder block in a prominent domestic customer, resulting in increase in a content per vehicle for us. In a domestic two-wheeler customer, we have increased the portfolio with addition of a new part and will also contribute to increase the content per vehicle. In the non-auto business, we are working on a tenders for the 2 products. One is for the supply of wheels for the battle tank, and we are also in line to win the order for a cylinders for the heavy-duty defense truck, which will come into production in the coming quarters. On this note, I would like to now request our Group CEO, Mr. Veera Babu, to share his perspective on the performance for the quarter.
Thank you, Raju. Good day, everyone. With a good performance this quarter and with outperformance compared to the domestic and global industry, we are actively working on certain initiatives to further build on the momentum. In order to further elevate our manufacturing excellence and process expertise, we are actively implementing digital process controls. This will ensure that our production process is elevated by an additional layer of supervision through mission intelligence. These will also provide us data which will help us actively manage the operation as well as provide inputs for better decision making going ahead. Secondly, we have taken the initial steps in our automation journey. A detailed roadmap has been drawn of elevating the areas in which automation can introduce in our process. We are working on assessing the advantages and the efficiencies this will bring, and various parts are being demarcated into those that can be fully automated versus those parts that can be only partially automated for now. As a forward-thinking organization, we are seeking to protect ourselves from any risk to the competitiveness from risking manpower costs. As we progress on this journey, we are confident that automation will bring a noticeable benefit across the process excellences and product quality in addition to cost benefits. We have significant aspirations to build the business further and have elevated our people processes. The focus is to acquire rich talent with the right technical expertise. As we seek to increase customer wallet share and enhance the share of value addition, it is essential to add a right talent which will enrich organization competency. We are actively adding associates with casting expertise and machining expertise to our global teams. In order to better deal with the complexity, we are adding experts from Europe who possess skills in design and tool development. By placing these experts in our European operations and leveraging the global teams for prototype development for global customers, we are ensuring that we are closer to the customer and are contributing to shortening the timelines for development. As we shared earlier, we are actively working towards increasing our sustainability footprint. The captive solar plant in India has been commissioned and will begin the contributing to energy consumption and contributing savings in the current quarter itself. The installation of solar panels at our facility in Europe will be completed this quarter and begin contributing in the third quarter. These initiatives will be meaningful transformation our energy mix. On this note, I would now request to moderate to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Raghunandan NL from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity, and it's good to see that.
Sounding a little distant. May I request you to speak a little closer to the mic?
I hope it is better now.
Yes.
Yeah. So it is heartening to see that revenue target has been increased to 2,200 crore. On my questions, firstly, can you give some color on execution of new orders in FY24? would you expect revenue to be over 1,600 crore this year, sir?
So, Raghu, for this, we are expecting to reach around the 1,600 crores because the second quarter will be the most critical, second half of the year will be the most critical because we are going to implement various new projects. The deliveries will start and there is a ramp up in the volumes for the new projects. So let's see the market, but we are expecting to reach that level of 1,600 crores. That is the target we are having in this year.
So the ramp up which you are talking about, can you call out which would be the main one? Would it be JLR, Toyota, and PSA?
Yeah, the ramp up you talk about, the major contributors would be Toyota. Everyone knows Toyota is doing quite well. The vehicle which they have launched, the Hyryder 1.5 liter and also the High Cross, and this is added with the launches even declared by Maruti because it's the same platform which the vehicle will go, and Toyota has given an official indications to relook on the capacities to support in the quarter 2 and quarter 3. So the main contributor is yes, Toyota. Second is PSA, yes, which you all know they have already invested in a plant in Bangalore, and the SOP have just started. So this also will productionize. We are expecting numbers to add from next month. And the good thing is this is for the domestic as well as the French market. So we know the vehicle which they have launched, it's Citroën C3, it's taking quite well, and we have good response from the French market on that ground. Third contributor would be Maruti Suzuki. As we have explained, we want to increase the portfolio in the passenger vehicles, especially in the markets and area where we were not there. And cylinder being a very critical and good basically showcase the capacity and capability, and that we are aiming, and which we have noticed in last couple of quarters, we are explaining addition of businesses with Maruti. So yes, we have these parts are going into supplies now, and we are expecting one more cylinder will join in the coming quarters.
So for Maruti, we are expecting a good jump in the volumes in the coming quarter, especially from the quarter 3, that is the second half.
Got it, sir. And on JLR side, company announced that they will be starting the bookings of their upcoming electric vehicle from October onwards. So even our supply should come in?
This JLR e-axle which we were announced, I think it was in August last year, the business what we have backed is again for a platform which will come in 24, 25. And we are working in a right pace on that project, and even we have given them an option where even JLR first time is working on that model of a critical development of a e-axle where they have done various iterations. And here we are on right track, but this will come in SOP in next year, not this year. And we are seeking to get support, major jump in 25-26 from that project.
Got it, sir.
To add on, basically on the previous point, even we are noticing on EV, the demand increase for Tata Motors. And we have explained last time, 2 of the motor housing we have already added. And this is now gaining a momentum. Also, we are coming across from customers that similar platform they are also exploring to other OEMs. So this is a very good opportunity where we get immediate volume increase for the part what we develop. So also Dana, which we added, is now picking quite well. So these are some of the main contributors which basically drivers which we think will support us to boost. But let's keep our fingers crossed because we know market is still volatile. What we understood from markets, especially on global, first half it noticed a growth of 10%, but we noticed in the second half the increase what they're expecting is 1 or 2% only. That is because the US, we know the interest rates have at the peak, and other challenges in economies like China and so on. But yes, we are ready on those ground. Also, we are exploring plan A, plan B, just to see that we don't fall back with the capacities what we are putting for these numbers.
And Raghu, in addition to this, like the ramp up of the new projects, as well as what we have seen that there is a shift of business, like Echo, what they are sourcing from China, so they are shifting to India. And we have almost finalized one big business with Echo. So hopefully from Q3 we will be able to start.
Which was the company, sir?
Tata Auto.
Got it. Okay.
Including the components for the Tata Group.
That's wonderful to hear, sir. Thanks so much for the detailed response. Vimal, sir, on the ESOP cost, the 3 crore cost was there in Q1. Is this expected to repeat even in the subsequent quarters?
So this is for this year. So, but from the next year it will be very small amount. Only this amount is coming for the current year. It is a notional cost.
So all things remaining constant, Q2 onwards, we should see margin around 12% then.
Let's see.
Yes, sir. And the captive solar plant in India and Europe coming in Q2 and Q3, Mr. Veera Babu spoke about it. So what kind of cost benefits can it provide?
So in India, almost we are expecting to make a saving of around 4 to 5 crores in a year.
Got it.
And in Europe also, let's see, I think, because it is all plants, so let's see 8 to 10 lakhs rupees. It will not be a big jump, big savings, but they are also going for this solar power.
Got it. So for the full year, is it fair to assume around 12% margin, or would you see any risk to that?
Yes, we are hopeful that we will be able to deliver this and maybe better. But it depends on the performance, because because only this what we are seeing the second half, how this overall economy performs in global market especially. Otherwise, we have very strong order book, demands are there, and we are seeing the improvement in the operations, costs are going down. So let's see.
Got it, sir. And the journey from 12.2% margin in Q1 going towards 14% margin by FY2025-26. So would it be right to assume that one, scale benefits, second, mix improving towards more value-added and overseas products, and third, your cost-saving efforts like automation, what would you think would be the top 2-3 factors which will take you to 14% over the medium term?
So the most important is the product mix. So what we are working. So especially as you are aware that our contribution from the two-wheeler that was higher in the earlier, that is started going down year-on-year basis. Right? So that we used to have more than 50% just years back. Now we have reached up to 43% in this quarter. So that is one. And second is the cost down projects, what means our efforts to reduce our cost. And third is in last Concall we have explained about the stabilization cost of the new projects. So hopefully new projects have started stabilizing, so cost of those parts production costs have started going down. And another benefit generally we get that economy of scale. So these are the factors, those are going to drive to improve our margins in the coming years.
Got it, sir.
Also to add on, we are working with a concept where we can increase our sale per machine. That's the reason we are exploring more towards a bigger and bolder part, which will give us a more revenue over the traditional parts where we were into. And also, if parts are small, we are working in a model where we can offer customers multiple tooling solutions, where again with the aim to increase our sales per machine.
Got it, sir. Thank you so much for that. Last two questions from my end. Sir, on the debt side, how do you see the reduction in net debt? I mean, we are planning a capex of 90 crore, but given the kind of growth we are seeing, we should be generating positive free cash flows. So how do you see the trajectory of debt reduction over the next 2 years?
So let's see, but based on estimates, I think at this moment we are near to 300 crores, 290 or 295 crores in that range, 300 crores. So hopefully in next 2 years, I think 70 to 80 crores we should be able to reduce our debts. Got it. And last question on the tax rate. What rate should we work with, sir? Around 24-25%? Would that be a fair assumption? The new tax regime we have now started following, so that will come in the range of 24-25%. Got it, sir. Thank you. Thank you so much. Very useful. I'll come back in the queue for more questions. Thank you.
Thank you. Next question is from the line of Saurabh Jain from Sunidhi Securities and Finance. Please go ahead.
Thanks for the opportunity. I have a couple of questions. First, to begin with, sir, you have upped your revenue guidance by almost 10%. That's quite good. That shows our confidence and, the momentum in the orders. So, I just wanted to know, would you still call it conservative, as we had been mentioning that 2,000 crore is a conservative number?
Yes, that actually in our speech I have already explained that we have now improved the guidance from 2,000 to 2,200 crores by 25-26, approximately CAGR of 16%. But that is explaining to the group that we have a lot of opportunities are coming up. Especially one we are talking about the development of the new parts, because that takes little time for the ramp up converting into the volumes. But another good thing is that we are receiving a lot of inquiries and we are in discussion with various OEMs or the tier 1 suppliers about the shift business. So the resourcing of those parts, either from China or from other vendors or other countries, that is started. So hopefully we will be able to revise our guidance for 25-26 in the next quarter, maybe next coming 6 months on the upper side.
Wow, that's great to hear. Sir, my next question is on gross margins. On sequential basis, our margins have dipped. So what is the outlook going forward? Do we see margins improving with metals stabilizing now?
Metal is almost stabilized. So definitely our focus is more on the improvement on the margins. And we are working on each and every area of how we can improve this. So like major focus is from the change in the sales mix, the product mix, that is going to happen. And we have already explained the order book size, the new orders, what we are getting from the new customers or new parts or from the existing customers. So that is happening, and when we are going for the new businesses, so we are mainly focused on the margin side and the ROC. So that is definitely in the coming period that we will be able to improve our margins.
Okay, so for last couple of fiscals, it was below 49.5%. So now this quarter it is at 50.4%. So, can we assume around 51% for the full year and onwards?
We hope so. Totally depends on the product mix, but definitely our assumption is also that it should improve.
Okay. My last question, sir. What numbers should we work with for depreciation and finance cost for the full year, since these numbers were on the higher side this quarter?
So, interest cost, one is that has impacted our what we call interest rate increase. that in the last year has happened. So hopefully, because we don't know, but at least we are hoping that as stabilized means that there will not be any further increase in the interest rates in the coming period. So, and other side now we are more focused how to reduce because some opportunities like export is increasing. So more focus on the ECSC, so take that benefit and reduce our interest cost. And another little bit increase in interest cost is from our lease assets, and depreciation is also increased. When we generally our life of the asset we consider 10 years or more. So for the depreciation side, but for the leased assets, so that has also impacted on the depreciation approximately around 40 to 50 lakh rupees for this quarter. And we have also made some corrections in the life of assets because based on what expectations of the utilization of those assets, so that also impacted around 70 to 80 lakhs in this quarter.
Okay, so should we work with this 18 crore of depreciation on a quarterly basis for next coming quarter?
Around that, yeah.
Okay, fine. That's all from my side. Thank you. All the best, sir.
Thank you.
Thank you. Next question is from the line of Yash Dalal from Sushil Financial Services. Please go ahead.
Hi. Firstly, congratulations to the management on a
Sushil, your audio is coming Yash, your audio is coming feeble.
Can you hear me now? Hello?
Slightly better.
Slightly better?
Yeah.
Yeah, hi. Firstly, congratulations to the management on a better set of numbers and stronger margins, and thanks for this opportunity. So just a few questions. First, you mentioned the introduction of a new technology, friction stir welding. What exactly is this technology? What are the opportunities? Can it be a game changer? And also, you've received a 90 crore order for this, I believe, from your commentary.
Yes, thanks for the question. Yeah. Friction stir welding is a solid state joining process, and it has lots of application in the EV, and it has lots of advantage as compared to the current processes which are in the industry right now. We have got the new order for this technology from a European company that is worth 90 crore, and we are in discussion with a couple of more customers for this technology. And I hope we will be in a better state to give you further update in next 2 quarters once we will finalize the next orders from the new customers. But to summarize, we see a good opportunity in the field of FSW to bring new orders and improve our product mix.
So, yes, this is a great opportunity what we are seeing at this moment. Because we are new and this is a patented technology that we have brought in India, and there is a huge demand for this product. So, but this is the initial start, so we are not in a position to give some guidance on this, the numbers, but big opportunity we are seeing here, but we will be able to give more clarity in the coming quarter, maybe next quarter or next 6 months.
Yeah. And to add to this point, basically the opportunity to increase value addition is there when we give assembly parts when we talk about EV. So this is again one of the tools which will help us to give assembly part to a customer and fetch a higher VA. Secondly, at this moment these technologies are there in Europe, in China, very limited in India. So we've become a first mover with this technology, and we are quite sure with introduction of this technology, a lot of RFQs and requests will come from our existing and prospective customers, which is in line with our strategy to increase our portfolio in the carbon neutral footprints.
Okay, that's great to hear. And just another question. So JLR is setting up a battery manufacturing plant in UK, and of course we supply battery housing and motor housing to them. So once this plant is set up, what are the opportunities and prospects for Alicon in this?
Yes, we also came across this news in last week where Tata and JLR is coming up with a plan maybe in central of England or maybe Spain also they're exploring. Yes, at this moment they are focusing on this gigafactory of battery manufacturing. One is we still will have an opportunity to supply battery housing. As you know, we have already developed this battery housing from a European entity, and this where we have given a solution over a traditional way of making a battery packs. So yes, one is the e-axle part. What we added will demonstrate a customer also of handling such a big and critical part. Add on what we have applied. So yes, we are in close discussions and will be in close discussion to seek further opportunities under this project.
Okay. Thank you so much.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Suhas Naik from Krida Capital. Please go ahead.
Hello.
Yes, go ahead, sir. You're audible.
Yeah. Thank you. Congrats to management on a good set of numbers. I have a couple of questions. One is on the new areas. There are two areas which we talked about. One, you made a brief mention of defense, entry into defense. So could you talk a little bit about what is the opportunity that we are looking at in defense? This is the first area. And the second area you talked about the on the road charging. I just want to understand where is the opportunity for us in this. Could you just give us some idea about these two areas?
Yeah. So thanks for the question. So in the defense, we are already supplying the parts to CVRD, that is the India Defense, which is situated in Chennai, and we are already supplying the road wheels for the Arjun tank. And we are quoting the new tender, which will be for the next 3 years, and it's a big order for Alicon. That is the first one. Second thing, we are already supplying the cylinder head for the defense truck to BEML, and right now we are getting further tender of a much bigger quantity, so which we have already quoted to them, and we are the single source for all these two customers. So we see the revenue will increase, and the orders which will we get, that will be for next 3 to 4 years.
Okay, what could be the rough indicative size of these orders we are talking?
These orders value will be roughly in the range of 15 to 20 crores per year.
Okay. The other question, on a very broader scale, we are actually, as you said, 52% of the orders would be coming from the newer areas, the new technologies. So why are we only assuming a 15% growth? Because it looks like all the hard efforts put by you over the last few years, you're at kind of an inflection point now. At least that's what I got from when I heard to all the leaders in the team. So why are we just restricting ourselves to a 15% growth?
Yeah, rightly pointed this point from your side. What we are noticing, earlier they were dominant players in the market, and even the development cycles or a development lead time or a project life of our projects were very high. Now there are a lot of competition in the market, and the project life have come down. So that we are factoring. We know, like earlier, a part which was developed will continue for 10-15 years. Like for example, a Maruti cylinder which we developed for the 800, where we were supplying till around 30 to 35 years. So this has come down. Now also we are noticing some of the projects we develop, and some even don't click in the SOP. So those things we are keeping in mind, and now even new technologies are coming up from IC to EV. We know very well in EV also a lot of transformation will come. Like for example, we came across one article where Toyota is working on a new technology. It's a solid state battery which can run 1200 kilometers in one charge, and that batteries can charge in just 10 minutes. So we know very well a lot of companies are working in different adjacent technologies to grab the market and dominate the market. So with those parameters, we are keeping our fingers crossed.
Okay.
These are some of the pointers.
So opportunities are there. So we are at this moment just a little bit on the conservative side, and when things move, when we reach up to a very advanced stage, then we start revising our guidance.
And lastly, on the margin front, we are saying 14% is what we are aiming for 25-26. That's quite a good margin from where we are right now. But is there a ceiling there actually in terms of because I know there is a huge operating leverage. We are just 65% utilization right now. So operating leverage itself should take the margins to that 13-14% kind of a range. Apart from that, you are saying we are shifting from a two-wheeler, which is low margin, to most of the products now will be in the high margin category. So put all this together, and you're working on latest technologies where by itself there will be a better pricing. So taking all this into consideration, is there a ceiling of 14% out there in terms of margin at peak utilization?
For this little bit, because as I explained that we just work on the conservative side. So let's see, because earlier also we were not expecting that such kind of margin growth in the quarter one. And the kind of projects we are doing for the cost reductions and change in the product mix, hopefully we should be able to deliver better.
Thank you. Thanks a lot and all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question.
Yeah.
So, ladies and gentlemen, you may press star and 1 to ask a question. I now hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter.
Thank you very much. On behalf of Alicon Castor Oil Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.